Hi everyone. In 2025, two funds ran identical rules, screened companies the exact same way, and chased the same goal: growing dividend income. One returned 4%, the other returned nearly 34%. Same methodology, completely different result. And the fund that won by nearly 8 times, most SCHD investors have never even considered owning it. It is called SCHY. In this video, I'm going to show you exactly what it is, why it crushed SCHD in 2025, the hidden tax trap most investors fall into with it, and the one principle that determines whether it belongs in your portfolio. Stay with me, this one could permanently change how you think about building dividend income. Hey, welcome back. This is Invest ED, where we turn big financial ideas into simple steps anyone can act on. Nothing here is financial advice. Always consult a licensed professional before making any investment decisions. Quick note, the return figures in this video are from the 2025 calendar year. Total return includes dividends. Past performance never predicts the future, but understanding why these numbers happen is exactly what this video is about. Now let's get into it. What is SCHY, and why does it exist? SCHY stands for the Schwab International Dividend Equity ETF. Built by the same team behind SCHD, launched in April 2021, and running on the exact same quality engine. The only difference is geography. SCHD hunts for dividend champions inside America. SCHY hunts for them everywhere else. 100 high-quality dividend-paying companies from developed and emerging markets across more than 20 countries outside the United States. Think of it as SCHD's global twin. The entry requirements are identical. 10 consecutive years of dividend payments, minimum market cap of $500 million, scored on cash flow to debt, return on equity, dividend yield, and 5-year dividend growth rate. Top holdings include world-class names like BHP Group, Roche Holdings, GSK, and Vinci, global giants that have been paying and growing dividends for decades. The expense ratio is just 0.08% per year, $8 on every $10,000 invested. The fund paid $1.06 per share in annual dividends over the past 12 months. The current yield sits between 3.5% and 3.8%, and the 3-year dividend growth rate stands at 9.05%, actually faster than SCHD's current 3-year rate of 7.12%. Those are solid numbers on their own, but they're not what makes the story truly remarkable. Here's the number that should stop every SCHD investor cold. In calendar year 2025, SCHY delivered a total return of 33.98%. SCHD over the same period returned just 4.34%. Same methodology, same quality filters, same dividend focus. SCHY outperformed by nearly 8 times in a single year. This did not happen by luck. It happened because of the dollar. Here's the simplest way to understand it. Imagine you own a rental property in Europe that pays you rent in euros every month. The rent never changes, not by a single euro. But one year the dollar weakened sharply against the euro. Suddenly those same euro payments convert back into significantly more dollars than before, even though the actual rent never moved. Your income grew without your tenant paying a single euro more. That is exactly what happened with SCHY in 2025. The US dollar fell 9.4%, the worst annual performance in 8 years. SCHY's companies paid dividends in euros, British pounds, Japanese yen, and Swiss francs. As those currencies strengthened against the dollar, every dividend payment converted back at a more favorable rate, automatically boosting returns for every American holding SCHY. SCHD investors received none of that benefit because every SCHD company operates entirely in US dollars. This currency tailwind stacked on top of already attractive international valuations is what drove SCHY's 33.98% return, while SCHD earned just 4.34%. Understanding this mechanism is how you use SCHY correctly going forward. But here is what most channels covering SCHY never tell you. Currency risk cuts both ways, and it can cut sharply. In 2024, SCHY returned minus 1.77%. SCHD that same year returned a plus 11.66%. The dollar was stronger in 2024, and international dividends converted back at a less favorable rate, pushing SCHY into negative territory. Investors who bought during SCHY's strong period panicked when the dollar recovered and sold, locking in losses that patients would have completely avoided. SCHY also carries geopolitical risk that SCHD does not. Political instability in Europe, regulatory changes in Asia, trade disruptions in emerging markets. These forces can affect SCHY's holdings in ways that never touch SCHD. And at approximately $2.1 billion in assets compared to SCHD's over $84 billion, SCHY is significantly smaller. For a long-term buy and hold investor, this size difference rarely creates practical issues, but it is worth understanding before you commit. Now here's the hidden tax trap almost nobody warns you about. This is the section that could save or cost you real money, and most financial channels skip it entirely. When foreign companies pay dividends, many countries automatically withhold a portion of that payment before it even reaches you. In a taxable brokerage account, the IRS allows you to claim a foreign tax credit, a dollar-for-dollar reduction in your U.S. tax bill, to recover most of that withheld amount. It shows up on your 1099 DIV form and gets claimed on your annual tax return. Inside a Roth IRA or 401k, you cannot claim that foreign tax credit. The credit only applies to taxable income. Inside a retirement account, there is no taxable income, which means every dollar of foreign tax withheld from your SCHY dividends is permanently gone. For every $1,000 in SCHY dividends earned inside a Roth IRA, you could silently lose between $70 and $150 with absolutely no way to recover it. This creates an important distinction. For SCHD, which holds only U.S. companies paying U.S. dividends, a Roth IRA is almost always the most efficient account. For SCHY, a taxable brokerage account may preserve significantly more of your actual after-tax income because the foreign tax credit remains fully claimable. This is not a reason to avoid SCHY. It is a reason to think carefully about where you hold it. A conversation with a tax professional before you invest is genuinely worth your time. So how does SCHY actually fit into a portfolio built around SCHD? One clear principle settles this entire question. SCHY is not a replacement. It is a complement. SCHD gives you the best dividend companies in America. SCHY gives you the best dividend companies in the rest of the world. Together, they create something neither fund can deliver alone. A truly global income portfolio diversified across currencies, economies, and market cycles. When the dollar is strong and U.S. markets lead, SCHD leads. When the dollar weakens and international markets run, SCHY leads decisively. Holding both means your dividend income flows from two completely separate global pools at all times. You stop needing to predict which environment comes next because you are already positioned for both. Treat SCHY as a satellite position built around a core SCHD foundation. The right balance between them depends on your personal risk tolerance, tax situation, and time horizon, all of which deserve a proper conversation with a qualified financial professional. Here's the bottom line. Two funds, same rules, same quality standards, same commitment to growing dividend income. One covers America, one covers the world. When the dollar fell 9.4% in 2025, the worst annual performance in 8 years, SCHY returned 33.98% against SCHD's 4.34%. That gap was not a fluke. It was the currency mechanism working exactly as described. Holding both funds means you stop betting on one outcome and you start building income designed to perform across every market environment. The world's best dividend companies are not all American. SCHY is the simplest, lowest cost way to collect income from the ones that are not, while the same quality filter that built SCHD's reputation quietly does the same job for the rest of the world. If this video helped you understand SCHY and how it fits alongside SCHD, please hit the like button and subscribe. Drop a comment below. Do you already own SCHY? Are you thinking about adding it? Or do you believe SCHD alone is enough? I want to hear both sides. I read every single comment. See you in the next one. Smart investing, profitable results. This content is for educational purposes only. Nothing here is financial advice. Past performance is not a guarantee of future results. All investments carry risk. Please consult a licensed financial professional before making any investment decisions.